Today we're diving into an accounting secret, one that explains how two completely identical companies can look so different on paper. It's all about how they account for their materials. So let's get into it.
Okay, just picture this for a second. You've got two coffee shops right next to each other. They sell the exact same beans, charge the exact same prices, but at the end of the year, one posts a massive profit and the other, a much smaller one. So how is that even possible? Well, it's not magic, and it's not a mistake. It's a choice.
You see, the secret is that accounting isn't just about plugging in numbers. It's about making strategic choices. The methods a company picks to value its inventory can totally change the story that its financial statements tell. So let's open up that toolkit and see what's inside.
All right, so the very first decision the business has to make is pretty fundamental. How are we going to keep an eye on all our stuff, on our inventory? This choice really sets the stage for everything else, and it basically boils down to two different systems.
Think of it like this. A perpetual system is like a live scoreboard at a basketball game. It's constantly updating, in real time. Every time an item is sold, boom, the system knows about it instantly. A periodic system, on the other hand, is kind of like waiting until the game is over and then going back to count all the baskets. You only get the full picture at the very end.
So which one's better? Well, it totally depends on the business. A huge supermarket with thousands of items and checkout scanners absolutely needs a perpetual system to know when it's time to reorder milk. It's essential. But, a small local hardware store that sells tons of nuts and bolts, they might be perfectly fine doing a simple periodic count at the end of the month. It's all about balancing the cost against how badly you need that real-time info.
Okay, so once you've figured out how you're going to track your inventory, the next huge question is this. When you sell something, what cost do you assign to it? This is where it gets really interesting and where we get into the three main valuation methods.
First up, we've got FIFO. That stands for first in, first out. And the logic here is really simple and intuitive. It assumes that you sell your oldest inventory first. It's like a queue at a shop. The first person to get in line is the first person served. This method makes perfect sense for businesses that sell things that can expire or go out of style, like food or fashion.
Let's follow the numbers here to really see how FIFO works. See that sale on January 10th? We assume the first items we bought are the first ones we sell. So we expense those 100 old units that cost us $10 each, and then 50 of the newer ones that cost us $12. Now here's the key takeaway. The inventory left on our books is valued at the newest, most recent prices. And this is going to be super important when we talk about inflation later on.
Next up is AVCO, or the weighted average cost method. Now, if FIFO is all about following a sequence, AVCO is about smoothing everything out. It helps you avoid any sharp spikes or drops by creating this sort of rolling average cost for all your inventory. It's a great method for businesses that deal with stuff like oil or grain, where prices can be all over the place.
Now here's the absolute #1 rule for AVCO, the one thing you can't forget. Every single time you buy new inventory at a different price, you have to calculate a new average. Look at January 5th. We blend the old stock with the new stock to get a new average cost of $11.33. That price becomes our cost for every single sale until we buy more stock and have to do the math all over again. It's a constant process of smoothing things out.
And finally, we get to the one that feels a little backwards, LIFO, or last in, first out. This method assumes you sell your newest inventory first. The best way to think about it is like a stack of plates in a cafeteria. You always grab the one right on top, which was the last one put there. Those plates at the bottom, they might sit there for a very long time. And just look at what happens to the numbers. With LIFO, we match our sale against the most recent, most expensive inventory we bought, those units that cost us $12. This makes our cost of goods sold higher. But what's left on our balance sheet? The old, cheap inventory from the beginning. It's the total opposite of FIFO, and it paints a very different financial picture.
Okay, this is a huge deal. While LIFO is a perfectly valid concept and it's actually allowed in the United States under their rules, it is banned pretty much everywhere else in the world that follows International Financial Reporting Standards, or IFRS. And the main reason is because it can really distort a company's financial health by leaving super old, unrealistic costs sitting in inventory forever.
So we've got these different methods, but why on earth would a company choose one over the other? Well, the answer has everything to do with what's going on in the economy, especially one little word.
Inflation. Yep. When prices are going up and up, the choice of inventory method stops being just a boring accounting exercise. It becomes a major strategic decision that has a direct impact on a company's reported profit and, maybe most importantly, its tax bill.
This table really lays out the trade-off, doesn't it? When prices are rising, FIFO makes your profits look bigger because you're matching old, cheap costs against new, high-selling prices. And hey, investors love to see big profits. But that bigger profit also means a bigger tax bill. LIFO does the opposite. It gives you lower reported profits and therefore a lower tax bill, which is great for your cash flow. And AVCO? It just sits right there in the middle, nice and steady. Your choice directly hits your bottom line.
And this right here is why the type of business you're in is so important. For a food company with products that expire, FIFO is the only thing that makes sense. It actually reflects how their products move. But for an oil refiner dealing with wild price swings, AVACO gives a much more stable and realistic picture of their performance over time. The method has to fit the reality of the business.
So, getting the calculations right is one thing, but professional accountants know there are two more critical steps to make sure the numbers aren't just accurate, but that they're also honest and reliable.
I don't care how good your computer system is, eventually you have to get out there and physically count what you actually have on the shelves. This is the ultimate reality check. It's how you discover things like theft or damage or just simple data entry errors. And for auditors, this physical verification is absolutely 100% non-negotiable.
And here we have one of the most fundamental ideas in all of accounting, prudence. Now, in simple terms, all this means is you should never, ever overstate your assets. If the inventory you're holding is now worth less than what you paid for it, maybe it's damaged or just yesterday's news, you have to recognize that loss right away and write the value down.
This slide shows it perfectly. Let's say you've got a warehouse full of last year's smartphones. You paid $8 grand for them, but now that the new model is out, you can only sell them for $4 grand. Well, the prudence principle says you have to value that stock at $4,000 on your balance sheet and record a $4,000 loss. It's all about presenting a true and fair picture of how your company is actually doing.
So let's wrap it all up. We've seen that you can track inventory in real time or just count it at the end of the period. We've explored how your choice between methods like FIFO and AVCO can completely change your profit and your tax bill, especially when prices are on the rise. And finally, we know that the pros always have to verify with a physical count and apply the prudence principle to make sure the numbers are truly honest.
And that brings us to our final thought. I want you to imagine you're in the hot seat. You're the CFO. Rising costs are squeezing your business. Using FIFO will make your profits look fantastic for investors, but it comes with a real cash cost, higher taxes. What do? Do you choose a different method that might be more prudent but less flashy? The choice isn't just about the numbers. It's about strategy, about priorities, and about the story you choose to tell. That is the real power of accounting for materials.